Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacity licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. Let's see what is going on the market. Actually, what's been going on since last week? What have we done? I think that's bigger. So last week was what is today? The 12th. So the 5th basically was last Wednesday. Yeah, that makes sense, I think. Wait, no. That would be Monday, Tuesday, Wednesday. The 4th was Wednesday. So last week we were at 25.30. Now we're at 25.51. Okay, so that's then. And the big move came after we did our webinar last week. We had that big move into the weekend. And since then it's been flat. So we have that big pump job right over there, and that was the end of it. Now we flatlined since, so we're in the middle of this big long flatlining curve. We thought we'd drop off after the Fed yesterday, and we did from there. We did, but this isn't what I call a drop off so far. Portfolio-wise, that's a good way to check. Let's see how we're doing compared to where we were. This is from. The review is from 9/29, but the actual dates were around the 15th, around the middle of the month last month. So here we are right again. We're back at the middle of the month, so I guess basically this is a month of progress, or lack thereof. We'll find out. Let's see. So looking at the short-term portfolio, that's bound to be sad. That's not so bad, 331. All right, so 431 here. And we were at 487, so we're down 50. That is bad. So we're down 50 on the short-term portfolio with the hedges. And don't forget, we actually pushed our hedges and increased them, so we got more bearish. So hopefully, the long-term portfolio made up for that. That's the short-term portfolio. The long-term portfolio is at 1649, so 1650 basically, and it was at CL60, yeah, okay, and it was at. Because you can't go over every position, but conceptually you want to see what you're down to. So it was at 60. So we have done exactly what I thought we did. We're flat. I mean, this thing's up $44,000. The other one's down $51,000. Yes, we lost a little bit of ground. Lost about $7,000 on our two portfolios in the last month. So it's been not a very exciting month so far. Now, of course, midday readings, and you don't know where exactly things are going to settle. There's a little bit of randomness in the thing, but that just shows we are really, really put on the brakes. We are not at all bullish. I mean, not that there's been a big move up in the intervening period, but certainly we're not making any bullish benefits from it. Probably we're going to see the same thing in the in the options opportunity portfolio, let's see. Next portfolio, LTT Port 3. Wow. And these things are a lot of work. Okay. Butterfly portfolio. I forget how much work I put into doing these things. So the Butterfly portfolio was 371. And now it's 396. All right, that's good. So the Butterfly portfolio is up 25. That makes sense, though, because you know what? The Butterfly portfolio doesn't have hedges. That's the weird thing about the Butterfly portfolio. We don't have hedges. It's self-hedging, so there's no particular negative bets on the market here. And we do have some fairly bullish positions in the Butterfly portfolio. So that makes sense that we made a good amount of money on that one. And then the big wild card is going to be the options opportunity portfolio. Let's see where that falls in. That one is self-hedging. I didn't get as aggressively bearish. I don't think I got as aggressively bearish in the options opportunity portfolio. Maybe I did, though. I might want to take that back. Here it is. The OOP was at 321, and drumroll, we're at 324. Yes, so basically we're locked in. We're doing exactly what we wanted to do. So we're in good shape. The balance is good. The only thing we're not doing is making money. We're not losing money, but we're not making money. But I don't mind that, because if that trend continues and we do have a downturn, I'd be very thrilled to just simply not lose money. It would be great. So the long-term, short-term pair are down $7,000 between them. The options opportunity is up a few $1,000s, and the Butterfly is a star, but that's mostly because it doesn't have any real specific hedges. So that's where we're standing at the moment. And actually, you know what I'd like to do? I'd like to go through, I want to talk about stock picking today. So I think we could do that by looking not instead of the portfolios, but why don't we look at the top trades and see how they're coming along. For each top trade, we have a nice description. So I want to get to that next. I want to talk about the top trades and why we pick things and what we expect of them and so on and so forth. That's going to be a good lesson for the day. So let's see what you guys want to talk about. They want to talk about the afternoon and how things are good. Oil just took a nosedive. Can you design a CM trade with options? Yes, I can. I am that good. I could do it. I don't want to, but I could. Oil, what's going on with oil? Yeah, I don't know what that's about. Anything exciting happening in oil? Let's see. Whoops. Twitter. Oil. IEA sees oil prices in 2018 rising on demand. That's nothing exciting. They always say that. Nigerian court seeks houses. Who cares? Oil spills. Trump's top blind safety official also owns a company selling supplies for cleaning up oil spills. Oh, that's great. OPEC sees the oil inventory glut gone in a year. That was recent. Shell buys a producer. That's what I'd be concerned about. Shell bought electric vehicle charging stations. You know, I don't know. I mean, nobody's a long-term investor anymore. But if you're buying something, you should want it to know it has a future. And when you see like major oil companies starting to invest in like electric car charging stations, you got to think it might be time to get out of that oil business. Let's see. Oh, if you put in oil, you get oil painting. U.S. oil inventory deviation from the 5-year average. Oh, I see. Okay, so in other words, obviously as time goes by, the 5-year average comes up and you have less deviation, unless your supply is constantly increasing. So So we're only 70 million barrels above the 5-year average now, down from a high of almost 140 million barrels above the 5-year average. So yeah, they've worked off some excess supply for sure. But there's nothing, I don't see anything particularly exciting to explain that. So we will just have to say it's one of those things. Where's the, there you go, the 50, yeah. It's just, for whatever random reason, probably, it's not so much the oil fell off, it's that this spike was pointless. There's no reason for the spike up, and there's no reason for the move back down. You know, people just moving around based on rumors or whatever, and it's going to spike up and down. But this is basically the range you can expect it to be in. Anywhere from 47.50 to 52.50 is the range for oil, and if you cut that in half, it'd be 51.25 to 48.95 to 48.75. So it's going to be $1.25 up and down would be the tighter end of the range. And I think, see here, at 51.25, I think we're kind of probably going to stay in that little tighter zone for a while. It makes it very tough to play. It's not a great time to be playing oil in either direction. So I'm certainly not highly in favor of it. Natural gas is bumping up on 3 again. So where was it? Oh, CM, please advise on T&GE and recently. Okay. New design CM trade with December 18 options. Well, first of all, what have they been doing is the question. Why December? It's so soon. See, I don't think it's necessarily a great time to play them, and their dividend is what? It's and what are you trying to accomplish? The dividend's $1, you know, or $1, whatever, per quarter. So that means you know it's going to drop $1, which means 90 is going to be really hard for this thing to get over in the short term. Okay, there's good reason for 90 not being likely to be punched up over. Because aside from that, they have to get over the 90 line, they also have the upcoming dividend payment of $1 that's going to drop the stock basically $1. So until they pass that, I don't think you're really going to get over 90. So that would be my A premise is that. But again, you bother me with the December thing. I wouldn't buy that stock at this price just to hold it for a few months. I like them. They're on our portfolio, but I like them as a very long-term hold. Because look, if you buy them for 89 or 90, it's almost 90. So you buy it for 90, you sell the calls for $2. You're going to get $1 in dividends. So you're going to get $3 total. It's going to be, I mean, it's not nothing. It's 3% of, no, it's not 2% of what you pay. So the dividend plus the short call is 2% of what you pay. But where's your protection? First of all, you're going to get called away at 90. You paid 90. You're going to make $2. You're going to make $3. You'll make the dividend payment and you'll make the money that you sold on the call. So you can make $3 in 3 months with a $90 stock. I'm not sure why I want to do that. I would certainly rather have $90 cash to go around and figure out what to do with it. It's not a good stock for an artificial play. If I was going to do anything, I would sell the 85 puts for $2 or $2.15. And the reason for that is because it's more than the dividend, the March. It's more than the dividend. Even if you get 2 dividends, it's more than 2 dividends. You don't have to own the stock, and the only way you do own the stock is if it drops down $5. And even then, your break even is $2 below that, so $7. So your break even is $83 instead of buying in for 90 now and maybe making a few bucks. I don't have to spend the cash. It depends on your margin, of course. If you're in an IRA and it's going to hold your margin anyway, you might be better off with this one. But in that case, I'd still go out to March, though, because in March you can at least get $3.50 for the $90 calls. And you can buy the stock, sell the calls. You can even sell the puts with the calls, as long as you don't mind doubling down. But again, that goes back to I'd rather buy half as much stock as I intend to buy, sell the puts for $2, sell the calls for $3.30. So now I'm like it's like $5.50 off the price. So I'm getting $5.50 back in my pocket immediately buying the stock. So if it's 90, it's going to be $84.50 is what you're buying it for. And the worst case is you'll get doubled down at 85, so you're still basically 84.75 for an average. And so that's your worst case, is buying it for 84.75. Meanwhile, though, you're going to collect your dividend, you're going to collect the short call money, you're going to collect that, so you can get $6.50 back on your $89, and most of that goes in your pocket right away. Or maybe you collect 2 dividends, and then it'd be $9.50 back. So that starts getting attractive. At least it's reasonable return for tying up $90. But on the whole, again, we just had this conversation in chat. I don't play these things. I don't play a stock that just went up from 50 to 90. I'm saying just it's 2 years. I understand it's 2 years. It just went up from 50 to 90. I don't give a crap if it's 2 years. It's too much. 75, maybe, maybe not. But it's certainly not 90. I'm not paying 80% more than somebody paid 2 years ago for a bank. And I like them. Again, I like them. They're in our portfolio. I just wouldn't pay now that kind of money. And we wrote about that yesterday. You've got to have, it's not their valuation relative to other people who are overpriced. It's the intrinsic valuation of the business as a business. Is that business the best use of your capital? That's the question. Not whether or not you could point to some other bank that's even more ridiculously priced. So here's our CMs. And what we have is, we took the money. We took the wrong money off. Oh, no, we didn't. Here it is. Sorry. We have 300 shares that we bought back at $74.50. Oh, see, it's funny. I said I would have bought them at $75. I did buy them at $75. So $74.50, I can deal with buying that price. And at the time, I don't remember what puts and calls we sold at the time, but we sold some puts and calls then, reduced our basis. Since then, in June, we sold these puts, and in the 80 puts, which are very safe looking and look like they're going to pay us off, and we sold those for $4.90 at the time. So in June, we sold the December puts for $4.90. Now it's September, and to sell the December puts, what do we just say? It's going to be $2. So it's no longer, it's the same stock, but it's not the same reward. Right stock, wrong time. Not to mention it's 33% higher than, or not 33%, but whatever the hell it is, $15, 20% higher. It's 20% higher than it was at the time. So it's 20% higher, and you're getting way, way worse money for the option. So why? Why would I do this? I have no reason to make that play. You got to pick your spots, and you've got to pick your conditions, and it's all got to be right. Not just one thing is right, and you're going to plow forward anyway. There are better ways to use your money. And in fact, that goes back to what I wanted to talk about. Phil, please advise on P&G and weakness. Look, GE is GE. It's like a giant battleship, and while they're turning, they're vulnerable. And basically, while they're in units, by turning I mean retooling the company, moving in a different direction, changing departments, deciding what to keep and what to move. Every so often, GE has to look at themselves and say, well, where are we going to be for the next 10 years? And if they're going in the wrong direction and they see that things have changed in the economy, like solar is a big thing now, so they want to concentrate more on things like solar installation and big infrastructure projects in energy and things like that, and clean tech. Even though America doesn't give a crap about this stuff, the rest of the world sure does. So GE's got to cater to their client base, and they've got to plan 10, 20 years down the line, because they take bids on contracts. First of all, they go into contracts. They bid on a contract that the bidding process is 2 years long. Then when they get the bid on the contract, the completion process is 7 years. So they're actually, they're bidding now on things that are going to be completed in a decade. Now, I used to do this. And it's tricky because you have to be a futurist just to make the bid. Because you have to bid based on what you think all the parts and the materials and so on and so forth are going to cost over the next decade. You're bidding into a binding contract. Now, to some extent, you can use futures and trading and such to lock these things up and make sure you're going to get your prices. But to other extents, you just have to take a chance. Like I would have to, if somebody asked me to supply a phone with iPhone X, iPhone 10 specs, right? Now, bid on it now for a delivery 3 years from now, I would bid $600. Because 3 years from now, that phone will be, the phone with the specs that this one has now is going to be much, much cheaper. Because I know that this will improve and that will improve and so on and so forth. So the phone that they want specced out now, the top-of-the-line phone, is going to be a very bottom-of-the-line phone by the time they have it delivered. But you've got to bid what the contract says. The contract wants it. I tried it the other way. I've tried going in and explaining to people like, oh, you don't really want to make your bid this way. You want to bid this way because you don't know what you're going to get. Or down the road, you should expect to get better stuff. Nobody wants to. It's too complicated. They only want to bid for whatever's currently top of the line, whatever, and get it at a certain price. And whoever comes up with the best price, they'll take delivery. And you can win so many contracts playing this game, especially government contracts and things like that. It's amazing. So anyway, back to GE. So GE, that's the kind of stuff GE does. That's one thing. AT&T, on the other hand, big infrastructure investment. But little known fact, AT&T is heavily competing right now with Verizon, putting fiber to people's homes. So they've gone on the attack, and they are now putting fiber in. So that was an AT&T fiber going in all over the place. That's going to stop people from switching to Fios, and also AT&T is trying to take over your TV business. Again, Verizon is much better at that than AT&T has been. Verizon bought Dish, and so they give you all the satellite and blah 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 on their things. AT&T has their own deals, and expect them to buy somebody to deliver content as well. They already have a lot of deals with a lot of people. All this stuff, it converges eventually. But while it's being built, in other words, the cost of what AT&T is doing right now is massive, but it's the same cost that Verizon was doing a few years ago when we liked them. We liked Verizon because other people didn't like them because Verizon was spending money to put fiber everywhere. But it kept them down for quite a long time. And I never liked Verizon more than AT&T. I always liked AT&T more than Verizon, except there was a period back a few years ago, I forget where exactly, but let's see if I can pull this chart out. I don't remember where we were. There was a period of time when Verizon was so out of favor. I guess it was here. Yeah, I guess it was in 2015. So back here, it wasn't 2013. It wasn't this. This was just a crash. So it was here when they were really, really pushing the Fios stuff, and I liked it. I was like, fine. I mean, so what? Of course, they're incurring costs putting fiber everywhere. That's what they do. All right. So now AT&T's are getting to that cycle, and their costs are increasing. But they're really just coming back. First of all, we haven't been interested in AT&T since they broke out of into the upper 30s. We like AT&T at 35 or less. So they're coming into the point where we'll buy them again. We don't, as far as I know, I don't think we own them. We almost always own them, and they just got more expensive when we stop buying them. So now they're getting interesting. That's my take on that. And GE we do own. We haven't pushed our bet on GE yet. We're waiting to see if they ever find a bottom. Word is they're going to cut their dividend. If they cut their dividend, then there'll be a lot more people bailing. But people are already bailing in anticipation of them cutting their dividend. But I like it when a company cuts its dividend. I don't want the company to have nothing better to do with money than give it back to me. If I want money, I won't buy the stock in the first place. I mean, yes, it's nice to get an income from dividend-producing stocks, okay? But in reality, we know how to make money with a stock. We don't need the stock to pay us a dividend to make money. We have a lot of ways to make money with a stock. When a stock pays you a dividend, they're paying you to hold the stock and not mess around. The problem is people these days they can't hold anything for more than a few months. Drives them crazy. So meanwhile, GE gets no reward for paying a big dividend, and at the moment they could use some cash for the stuff that they're doing. But down here, 22, absolutely. And what do we have? I don't even remember what we have. Where's our GE? I know we had it. Oh, there they are. We bought the stock. Yeah, okay. So we bought the actual stock at 27.40. Now it's 22. I'm not really ready. I'm not really looking to double down or anything like that. We're just seeing what happened. We sold the 25 calls. So, so don't forget, we bought the stock at 27. We sold the $25 calls for $3.75. So that's 24 minus 35 is 23.65. So our net is 23.65. We're right about where we netted into the stock. And we're collecting the dividends. The main thing we want to do is work with us is collect dividends. Now, the 28 puts are losing. We sold them for $3.10. They're now $5.80. That $3.10 though brought our basis down from 24 or whatever I said, 65 or whatever, to 21 basically, or a little bit over 21. But the question is now, are we going to have to buy more at 28? So if we look at 2019, either what, the 28 puts. So GE, we have a 2019 28 puts. That's the wrong symbol. GE. Do they even have 2020s out? Probably do. No, they don't. Unfortunately, they don't. So the 28 puts to 575. But let's say now they don't have that, but I can see the future because I can look at the 28 puts now, which are still 510, and now I can see what I can roll to if I go out another year. So these are a bit more obviously because they're in more time. So I would go to like the 25 put, which are 340. So at 340, if I roll out to the 25 puts, I'm lowering my basis 10%. I'm lowering my basis on the put by 10%. I've got my 310, but it's 340, not 580. So I would have to go to like 30 of these to make an even roll. Actually closer to 40. And I don't know that I want to commit to that. So we'll have to think about it. But we don't have to think about it now. We don't have to think about it until 2019. But as it stands now, it's still not a bad trade. So I still like it. I still like the whole concept of it. And as a new trader, I wouldn't mind it either, except obviously I would adjust to be at the right strike. What are your plans for the VXX position in the options opportunity portfolio? Is that in there yet? I don't know if we put it. I think it's new, so I'm not sure we have it. Or is it the SGYP? Is that what you're talking about? Did we do VXX specifically? I don't remember that. I mean, SVXY, that's what it was. Is this the one you mean, or did we do another? Because right now we have December 90, 80 puts, so they're completely out of the money, and this is failing. And what we're going to do is roll it. But I don't know if we did roll it, or we said we're going to roll it. But anyway, I'll probably stick with it because it's a good hedge. That's what it is. It's a hedge. This is a hedge. This is a hedge. This is a hedge. They're all supposed to lose money if the market's doing well. They are protecting the massive amount of money we're making on all these longs. Look at that. Green, green, green. Like solid green all the way up to there. Then we have some problem with TIVA. Oh, we know about that. Then we have a problem with TIVA, but it's not a big problem. It's down $3,000. This one's down, 25 something minus 9, so it's down $1,500. Then we're back to more green, mostly green. all green, nothing seriously red. This cancels out. This almost cancels out. Oh, this is GE. Frontier is our worst performer right now. Then green. Yeah, so ridiculous amounts of green. So this is what we're protecting with these hedges. So, what are we going to do with it? We're going to continue to hedge. We're going to buy 3 more months with this hedge, roll the position out, and we'll be protected for another 3 months in case it goes down. The maintenance of the hedges is cheaper than the planting of the hedges, which is really true in gardening as well, right? It's like if you start the hedge, it costs a lot of money, but to maintain the hedge is very cheap. So in other words, we're not ready yet, but SPXY, for example, we own the 90 puts, we sold the 80 puts. Okay? And it doesn't matter what actually, when we originally did the spread, it was a $6 spread, not even $6. So now, all I have to do is we take a look at what that's worth now, SVXY. And it was a December 90 puts that we owned. So they are $6. So those puts right now are the same price we paid for that spread. So if we move them, we're getting back all the money we put in the spread. We still have the obligation of the short 80 puts, but the reason we're moving them is because we've lost faith in SPXY ever getting back to 80 in time. Even if it does, though, we can always roll the 80 puts. So now we go out to March, let's say, and we're at 102. And so we can take the 110, which are $21, and we take the 110, and now what's $6 below $21? That would be 15, right? So who's 15? These guys, 97. So we could take the 110, 97 bear put spread. Now this one's in the money, $8 in the money, $7.50 in the money. So we could take that bear put spread for the same $6 that we're going to sell our 90 puts for. And the only way the short 80s that we're leaving on the table until December, the only way that those things even get paid back would be if our spread is 100% in the money. And since those puts are $4, we can look right now and see who's $4 in March. And in March, we've got the $60 puts at $4. So that means we won't really be in trouble unless SVXY drops to 60, drops almost 50% from where it is now. So that seems like a no-brainer, right? We could do that roll, have a much better position. It protects us all the way out till March. It pays as good or better than the spread that we have now. Yeah, we have a $10 spread, so it pays better than the spread that we have now, and it's at a way higher strike. So, but the net of that is I look at all that, and all that stuff takes me without explaining it, it'll take me 60 seconds to look at that and see all that. So the net of that is when I answer a question, somebody asks me that in chat, I'll generally say, oh, I'm not worried about it. That's why I'm not worried about it, because it's so easy to fix. It's not even worth considering. I'm not worried about moving the spread. I'm not worried about rolling the put, even if it does suddenly shoot down on me after I do it. And meanwhile, it's not like SPXY isn't going to move. I need a $20 move in SPXY between now and December. Is that realistic? That's the next thing you need to be aware of. It's saying, well, when would I make the roll? Well, I make the roll when it's not realistic that it's going to go down $20. So here, in the month of September, it's gone up $25 in 1 month. And in the month of August, it went from 93 to 68, another $25 move. And here we have another $25 move up. So basically every month it moves $20. Not can it move $20 in 3 months, but what month doesn't it move $20? Here, $20. There's $25 there, $25 there, $25 there. There's only 1 month. The only month, no, wait, I might be wrong. 80. Oh, nope, not this one. Only 13. So there's only 1 month in this entire period, in 6 months, that it didn't move $20 in a month. So, why? So to take an action now, when all I need is a $20 move down, that would be silly, right? I got no reason to do it. So we wait. I think it's stretched. I mean, I would have a reason if I thought it wasn't stretched, but it's stretched. It's ridiculous. The VIX is like, it's a non-existent thing. Where is it? Look at this. This is going back to 2013. This is crazy. This is going out to here. The last time this happened was when the market totally peaked out in 2007. And look what happened to it after that. Look what happened after it came this low. The only other time in a decade it's been this low was when the market got toppy at the end of 2007. And then we just went choppier and choppier and choppier until the market collapsed and the VIX went up 7 times. So that's what we're waiting for. I don't know when this is going to happen. I don't even know if that's going to happen. I just know at least this will happen. At least that's going to happen. And that's all we need. I don't know when. We've already got a very, very long period. Even this period is going to spike here and a spike here. And you just want to be in the right place when it happens. So we just roll it and roll it and roll it until we get a hit. And then we take it off the table and say, yay, we made money. Meanwhile, it's a hedge. If you wake up tomorrow and the market completely tanks, if this happens when you wake up tomorrow, then in the very least you're going to get a full payout on that, which is $20,000 you'll get back. And actually, it's not even $20,000. The spread is $20,000. Currently, it's $4,000 net. So instead of netting $4,000, you'll net $16,000 more. So that's your insurance. It's $16,000. You get a plus $16,000 if you wake up tomorrow and the market's tanking. $16,000 will come back to you. That's what hedges are for. Meanwhile, it's $4,000 now, and if we lose it, we damn well better make sure we're going to make $4,000 off of these positions. But we will because we sold a ton of premium. We know for a fact we're going to collect that. Oh, we had a VXX play too. I guess you didn't log it. Was that recent? Must be recent. Okay. Well, it'd be the same concept. Wait, October. VXX. In the options opportunity portfolio? It's not there, so the only thing I can think of is it must have been a recent one. Hang on, let me look at my thing where I got that open. I think it didn't get logged yet, that's the problem. Assuming that that's what it was. No, you are. What date was that? I don't see a VXX play for the options opportunity portfolio. The SVXY. I don't know, I'm stumped. VXX. I mean, it seems odd that we do a VXX. I mean, I'm not saying I didn't do it, but I'm just saying it seems odd to do a VXX when you already have the other one. Seeking alpha, research, Friday failure, volatility. Uh-oh. That's been misinterpreted. Oh, I can't even get it. Sign in. Oh, frick. I didn't even know how to sign in on that. Don't save me. Googly thing. This was an article. September 20. Well, I can go to September 22nd. Hang on a second. Bill. Folder. 1 second. I must have totally forgotten about that play. That's why we didn't log it in. Because it wasn't done up like a regular options opportunity play. I posted the article. You can make it. Oh, we did. Make it aggressive. See, I didn't put it the way I normally do it. It was right in the post. That's my bad. I didn't log it because I didn't put it in there. So we have October 40, and we're below 40 now. And we have the $20 calls, and we sold the 42. Well, that's not good. All right. Hang on. The October 40s. And what do we spend? Oh, we have a $350 credit. Oh, well, I'm not worried about this one either. I can tell you that already. VXX. So the October 40s are dead. Wow. They died fast and hard. Okay. Since we have a credit, the only thing we're going to do with these, because we already have the SBXY, so the only thing we're going to do with these is let them die. Now, we still have until next Friday, so it's possible they come back a bit, but these are dead. And that's my mistake, because I should have been paying more attention. I forgot we even had this trade, because I never logged it properly, and the reason I didn't log it properly is because I put it in the post and not in the special thing. So these are dead, and the only thing we'd be worried about is the short puts, which are the 42 calls, because we netted a 350 credit. The 42 calls are now $6. So what we do is just roll the calls back until they expire. So right now, we'd roll them down to like the 37 calls in January. And then since we started with a credit, we're just going to keep rolling the bad puts back until they expire worthless. And once they expire worthless, we're out of it and we didn't lose any money. So it didn't work out. We took a poke, it didn't work out, now we just dug the oldest short put. But yeah, thanks. I'm sorry about that. I totally I blew that because it was in the article and not in the regular things, and I totally missed it. I forgot I ever did it. And why would I do it? That makes no sense because we already had the other one. So look at the interest rate. So if you look at interest rates trend in the markets, I've always found that when the Fed starts saying the market starts moving down, yeah, well, of course. But the market tanks, the Fed does not have much tools to stimulate the economy. I kind of agree, but I think they've got one more in them. I think all the central banks really can push it one more time, so I'm not looking for any kind of big correction. I think that they can step in and do something, but I think that this will be the breaking point. And if they go in now, and they have to stimulate again, then they're really going to be out of ammo. But I think they've got enough sort of dry powder that if the market does turn down in a more than 10% correction, they will still be able to step in and provide some more stimulus and do something. Because basically they're going to go back to the full boat stimulus they were doing like 2 years ago. They kind of eased off that. So that's still there. That's still there where they can go back to it. They don't want to, but they should. All right, so that we got to fix. Somebody remind me of that in chat later. We'll forget again anyway. What did I want to get to? Oh, yeah, right. So let's talk about basic trade picking. So here's the top trade review that we did on the 30th. And we talked about, Restoration just got a bid and everybody's into that. So we were looking at Restoration Hardware, which had been a loser and turned around. But now let's talk about some of these. I want to talk about these ideas from scratch. It's kind of useful to say, what were we thinking about when we did these things? So on March 9th, we liked Exxon, and we picked this trade. And we did put it in the options opportunity portfolio, but you know what happened? It languished here, and in August, after the July 4th holiday, or I think maybe even before the July 4th holiday, we decided that we weren't going to get the oil rally we thought we'd get, and we got out of these. And I think we got out with a small loss or about even or whatever, but we got out of the Exxon trade. It wasn't doing what we wanted it to do. Okay, it has, at this point, made money because it went down and came back, and now it's above where it was here, but I'm pretty sure we got out as it got back near 80, we got sick of it. All right, but our logic was in March that oil was going to spike up in the summer, and that would be good for Exxon. And it never really panned out. That's the failure of OPEC to really get the price of oil appreciably above 55. Super value. Now, Amazon freaked out the supermarkets. It was going okay, but still not. But at the time I just did the review, we had 110, but I bet it got worse since then. We did the review, and it was at 9:30. So we did the review here, and they're down $2 since then. So very good for a new entry, which is cheaper now. So what do we think about super value? We did a thing recently in chat, and we talked about Kroger. And Kroger's got 2,700 stores. Super Value has 2,000 stores. Kroger makes more money, but Super Value is way, 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 way cheaper valuation-wise. So I definitely like Super Value better because if I'm a buyer coming in and I want to get my presence, if I'm a European buyer and I want to get grocery stores all over America, I don't really care about Kroger's current business, and I don't care about Super Value's current business. I care about buying 2,000 stores at one time that I can revamp. So who's a better deal for me? Super Value. In fact, Kroger's business is almost a hindrance to me buying them because they're going to say, well, we want good value for the money we're bringing in. And my attitude as a European or Japanese buyer is going to be, but I don't want the business you have. I want all new and different business. I want to compete on the Whole Foods kind of thing. I want to upscale you. So, Super Value's business, you could pretty much say bye-bye to it. It's smaller and it's more nimble. And frankly, the Super Value also is moving more into distribution, treating their stores like franchises. So that's an even better model for me. Because that way I can still get groceries from them, but I can put my own high quality spin on everything. In other words, I can just relabel the same shit they're giving me now but charge everyone more money. And then there's a business model, right? That's how you make money. So, and the thing about Super Value also, that's old. That's confusing. All right, so what did it become? 25 turned into short, long. Okay, so 13.25. So our bull call spread is deep in the money. That's another thing about this. We took the 13.25 spread, so we never thought it was going to go very high up. Because when did we start the trade? This was the same day as Exxon, March 9th. So in March, over here at 24, we placed Super Value with a 13.25 spread. We didn't think it was going anywhere. This was surprising to us. It went to 30. It came back down, and now it's drifting. And look at these, it's 2019, so we think that it'll be back up at, what do we say, it's 25. So we think it'll be back up around 25 in 18 months. But again, conservative play. And I like that. We're not owning it, we're just promising to own it, and we sold some puts. And the $4 puts are now 27 puts. So we sold these puts way up here. That's where we'd like it to be at 27. But we sold them for $1.10. So we don't really, as long as it's over 26, we're going to be happy campers, really. But even so, even at 25, we might lose $1 on 25 of these, but on 50 of these, we're going to make a ton of money. That's what we care about. Well, it's not 50 anymore, so you divide it by 7, which is very annoying. Then we've got Tesla. Oh, we have had a short. We keep shorting them and shorting them, basically. I missed this one. I had to kick myself, too. This is so, again, 385 is that sweet spot for shorting. So, when they started coming up here, we shorted last time. Then this time we shorted them again over here. And then here, we shorted, no, not here. This one we missed. I was greedy. That was my own fault. I was hoping they hit 400. They didn't hit 400, and they came down so fast. Didn't get it. But now, of course, they're playing their games again, and everybody's upgrading them, and hopefully they can come back up a bit. CDE's a little gold miner. I like them. this one was nice because it's already up $2,700. But what do we do here? This is from March 23rd, so here. And again, we went conservative, right? We take the 5-10 spread. So the stock's at 8, and we're doing a 5-10 spread. These are not ambitious moves. And we bought the 5-10 spread for it was only $1.85. No, wait, I'm sorry, not that. It's it's still $1.80. It's $1.80 for the 5-10 spread. We sold some puts to offset the cost, but that's irrelevant. The 5-10 spread was so cheap, there's almost like no reason not to buy it. But the key to the play is some sucker paid us $2 for $10 calls when the stock was at 8. Don't ever do that. Don't ever be that guy. That guy's an idiot. The stock has to go up 25% to get to 10. And he doesn't even make any money at 10. The stock has to then go up another 20% from there, which is now up 50% from where he started, just for him to get his money back. That's what 50% for him to get his money back. And we don't care because we bought the $5 calls to cover it. And when we bought the $5 calls, the stock was at 8. We paid $3.90. We only paid $1 in premium. This idiot paid $4.10 in premium. He paid $2.10 cash for calls that were $2 out of the money. He paid $4.10 in premium. That's insane. But that insanity is how we make our money. We take advantage of stupid people. If they're willing to take those risks, look, and believe me, there are plenty of reasonable risks. If the guy had bought these calls, if he had bought the $5 calls for $3.90, I'd say, hey, that's not so bad, because the stock was at 8. He paid half of what the stock cost, and he only incurred $1 of premium. So after the stock moves up $1, everything above that is gravy for him. That's not a bad trade. But realistically, I'm still going to say, well, where is it going to go? 12, 50% up from here in a year and a half? So if it goes to 12, how much will I make? I will make the full boat on mine, which is $5, less what we paid for, which is a negative. There's an actual credit on it. Oh, why does it say net $650? Oh, it's only 10. Okay, so the net is $650 here. So effectively, we're paying $650 for a $7,500 spread. Whereas this guy, if he only bought these calls let's say he bought 15 for $58.50. At 12, he gets $7 back times 15, math, 13.5. So he would make $8,000. So we're going to make $68.50, laying out $650. He would have to lay out $58.50 to make $8,000. So he's laying out almost 10 times more money than we're laying out, just to make 20% more. It's not a good trade-off. That's why we take these plays. And this trade we could close out now. It's up 426%. But we're like, well, it's up 426%, but we plan on making 1,000%. It's only on track. It's exactly where it's supposed to be for the amount of time we've given it so far. It's 1/3 of the way through. Now we have CHK, and that was down. So as of this date, it was down. Now it's down even more. It went down another 20, 30 cents. They did this is at the time in March. CHK did a restructuring after making. Oh yeah, they did. They bought oil wells and things right at the top. They decided to diversify into oil at the worst possible time. That's because Aubrey, the guy who used to run the place, he retired, and he eventually died too, unfortunately, in an accident. And the company just made some very bad decisions. He was great at feeling the market out. These guys are not so great at feeling the market out. Still, there's value to the company, so we liked them. And in this case, we were more speculative. We sold the $5 puts, so we put a value put down here. So far, obviously, no good. This was in March 29th. So the stock was at 6. And we played them pretty bullish. We said, I don't think it's going to go below 5. We're wrong so far. We sold the puts for $1.15. So our break even is right where it is right now. Is our break even on the put. On the call, we're pretty far out of the money. So we might consider taking these $5 calls and rolling into something lower in 2020. But I want to see their earnings before we make any moves on that one. GM exploded. That's an easy thing. Now, what happened was April 4th. Here's GE, April 4th at $34. And I just talked about this in the post the other day. Basically, we thought Tesla was so ridiculous in April that we said, well, you know what? Why don't Tesla's scary to short, but we could go long on GM because if Tesla's valued up here and GM's valued down here, either Tesla's going to come down or GM will come up with some combination of both. Okay, we have had a little bit of both since then. Now, it's up. I didn't know that. It's $11, so it's up like 30% since then. So obviously this one's hugely profitable and all that. The trade itself is up 166%. The way we traded it at the time, it was 34. We sold the 32 puts. Who doesn't want to own GM for that price? And then we took the 28, very conservative, 28, 35, 28, way down here. The stock was up here. Wait, what day we say that was? April 4th. The stock was up here, 34, and we bought the 28 call way down here. And we sold the 35 calls right here. So we were not even playing the stock to do anything. We just said, well, this is low enough, and we're going to take a stand. And that pays off. We could have made more money with a more aggressive play, but we didn't know it was going to explode out the gate. We just thought this was a great bottom to get into. And even taking a super conservative trade like that, though, we laid out 48.75, and and we get back 17.50. So we'll get a $12,000 profit, 258% if all goes well. So far we're up 166%. We're definitely way ahead of schedule because we're not going to collect all this money until 2019 January. But if you look at the chart, you say, well, do we want to do anything about that? See, not really, because we're totally in the money, we're not in danger, and all we have to do is nothing to make another 100%. Nothing. You have to sit here and wait for next January. Not a couple of months January, the one after that. That's how we look at this. Ford, same logic. We thought Ford was also undervalued. This is April 13th. It's down around here. And they again, erratic. We actually bought the stock. They pay a very nice dividend. GM pays a dividend too, but Ford, we like the way we structured it. So, you know why also? Because I don't mind. If you buy 1,000 shares of Ford, it's only $11,000. If I buy 1,000 shares of GM, it's $40,000. So I prefer to buy 1,000 shares of the cheaper stock and still get my dividend. Smaller dividends, of course, but I'm just saying, even though they're proportional, I don't have to lay out so much cash to be in that position. And there we sold the $12 puts, and it's going to go on a $10 call. So that was an interesting way to go. So basically, we bought the stock for $11. We sold the $10 call for $180. We dropped our basis below $11, but we're going to probably, almost certainly, get called away. We bought the stock here, and we are going to get called away down here. We gave ourselves a huge cushion to be in it. So we're just in this really for the dividend going forward. But we also sold these high puts. So that's where we took our chance. But you know what we did? Because we have 11.15 minus the calls of 180 is 10.15 minus 80 is 65. Is 9.35. Because we're into 9.35 here, we're happy to be assigned more at 12 because our net is only 2135, 1070 basically. So our net is 1070. That's our net entry if we get assigned. But, and also the bonus, though, is that if Ford does take off and it's over 12, which we hoped would happen, but it doesn't have to happen, then we pick up this bonus money as well. So several ways we can win in there. It's nice. GMC, super bumpy ride. That was April 18th when they were down, I don't know, I guess it was here. No, wait. Oh, no, it was before they exploded. It was into earnings. So April 18th, I said I liked them still, and I thought they were too cheap. Turned out they were too cheap. Again, though, conservative play. The 5,750 spread. They were up here. They were here at 7, and we took the 5,750 spread. Anything over 750, we get paid in full. And here I was not aggressive with the put sale. We sold half as many puts at the 750 line. So I sold puts that were at the money and picked up the call spread that was in the money. So even if it dropped down to 6, we still get $1 back for the call, and then we would have to pay the 750 calls about 50. So we would lose. No, we wouldn't. We would actually break even. So 6 is our break even point because we have 20 longs that would make $1, and we have 10 shorts that would lose $1.50. Actually, we'd still make money at $6. So, you see, like, when this is why all these things are green. How do you lose? Something really, really bad has to happen for you to lose when you set up your trades like this, right? The stock's at 7. We take the 5,750 spread. It's almost 100% of the money the day we start. We sell the 750 puts that are barely out of the money. And we sell them to some idiot who pays us $2.80 for a 750 put. 1/3 of the strike he pays us. That would be like the Google, we were talking about Google before, that Google's at 1,000. That would be like selling the 1,000 puts for $300 or $350. And some guy would pay you $350 to sell the 1,000 puts. Meanwhile, you're netting for $650. I'm like, yeah, I'll do that. There's no reason not to do that when people make an offer. It's almost criminal not to take their money. It's not our fault that these people are that dumb. But it is your fault if you're that dumb. Don't be that person ever. That person statistically has almost no chance in hell of making his money back. It would take a miraculous thing to happen for him to make his money back. But that happens. It does happen. People do go bankrupt. And that's what people are betting on. They're betting GMC would go bankrupt. At the time, we looked at it and said, no, they're not going bankrupt. They're, again, restructuring. That's all this is, restructuring. Still doing it. Not out of the woods yet, but restructuring. IMAX. They were recovering, but then the stupid Blade Runner movie killed them. IMAX is down for no reason other than we had a bad movie season in the summer. And IMAX doesn't even care about that because they're not making the movies. You know, they're like AMC. I mean, they're screening the movies, but they're not making the movies. It doesn't kill them that the box office is a bit light. So we'll see what their earnings look like. But the bottom line is they're still expanding their screens. They have a massive backlog, thousands of screens that are waiting to be installed. It delays that process a bit because their cash flow diminishes, and therefore they can't install as many screens as fast as they want to possibly. But on the whole, it's a very, very solid thing, very good down here. And we had a lot. And I said I wouldn't chase it as a new spread, but I'm adding 20. So we added more puts. More bull call spreads. Because we love these guys. I don't think the movie's over all with Dick. Tuesday, May 9th. And again, you see, notice the timing on these things. These are all things, not all. These are mostly from the watch list. Most of these trades come off our watch list, and what do we do with the watch list? We watch, and we wait. The watch list we made in February, and it was not a good time to buy ADX. It was not a good time here, but it was kind of quick, so we didn't really get into it. Then it came down, but then when it came back down here on May 9th, we said, ooh, that's too attractive not to buy. And what do? The 13 is at 16. We bought the 13 way down here, called. We sold the 20 way up here, called, but it was still in the range we had just been in. And we gave them until 2019. We sold the 15. The best way to see how enthusiastic I am about something is to see what puts we sell. That's your biggest clue. So at 16, I put my foot down and said, this isn't going below 15. And we sold the $15 puts down here, which it didn't go below 15, for $220. I can't believe it's only at $950. I mean, if you can still get that price, that's an incredible price. Wheaton Precious Metals was our trade of the year. What did we do? It was the same date, May 9th. So on May 9th, it came down again. That's why I said as a new play. We already have it. As a new play, I like it here. Anytime it comes down here, this is a good floor to start buying. Now, it's making very slowly, it's making one of the little triangle squeezy things, and it's going to pop out either up or down out of this range. Now, obviously, I think up. So it'll be interesting. But it's still going to take, for this thing to complete and come to meet up with that line, it's going to be this far, and that's about 3 months. So come December or January, we're going to see some fireworks on this guy. And it will very much depend on the price of silver and all that. Brazil, we just talked about in the post. Now, what was happening in Brazil? On May 19th, there was a meat scandal, there's a corruption scandal, there's all kinds of scandals going on in Brazil, and look what happened to them. This was exactly, the day I was on was the day that they was really falling apart. There's a meat scandal and the corruption scandal going on at the same time. In fact, the Chinese people were talking to me about the meat scandal, and I said to them, forget the meat, the corruption scandal is the thing you got to watch. So that was interesting. Anyway, but the bottom line is we liked them down here, and you just got to look at it and say, geez, this doesn't impact the country's economy that much. It's a huge country, $1 trillion plus economy. Imagine if America had a meat scandal and somebody said, Tyson Food had bad chicken and a whole bunch of people are sick or whatever, and so therefore America is done for. You know that's a ridiculous statement. Even if they tell you chicken's a really big industry in America. In fact, the movie industry is a big industry in America. It's our biggest industry. It's our single largest export. And it had a terrible summer. Yet the market's at record highs. Because no single industry like that is going to kill a real economy. Yet people, because it's not your home economy, people will believe all kinds of bullshit that analysts say. And the analysts sit there and say, meat is so important to the Brazilian economy, and blah, 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 blah. It's garbage. That's why I said it. The whole interview is right here. It's ridiculous. So we went heavy on Brazil. We actually put it in the long-term portfolio and the short-term portfolio and the OOP because it was too good to pass up at that price. And it went up a little bit, had a little bit more of a scare, and now we're back to normal. But we don't care about normal. We don't care. We played it. Again, we played it to be, it was here, and we played it to recover to 35. I didn't play it to go to 40. I played it to go to 35. Because that 35 play was net, what? Really? Oh. In the options, the small play was net $500 on a $10,000 spread. It gives you $9,500 in profit, and it was $7,000 in the money when we started. The bigger spread is already up $20,000. This is crazy money. It's just throwing money at you. It is unbelievable how much money they will throw you for these things. And all you got to do is use your head. Like, don't go with the crowd. Don't panic when everyone else is panicking. Taser was May 22nd. and they were here-ish in that area, and now they're back to where they were. But nonetheless, we're only up $50. So it's flat, basically. This trade is flat. Still a great trade. Actually, I'm sorry, it was flat when it was here in when we talked about it mid-September. Now it's up here, so it's probably better than flat now. So that's a great trade. Oh, and that was it. Okay. So those were our top trades for, what month was this? May. It started in March. I think it's March, April, and May. Those were our top trades. But you see what the theme is, okay? We look at things that are trading low in the channel. We have a watch list with dozens of stocks that we look at. So in other words, there's a watch list of stocks we'd love to buy if they get cheaper. Over the course of the year, every quarter, if you have a 24-item watch list like we do, every quarter, 2 are going to get cheap. Every quarter. It's almost impossible not to. Sometimes 3, sometimes 5. But, when you got 24 stocks, a couple are going to get cheaper every quarter and move to the bottom of the channel. Then you reevaluate them. You make sure you still like them. You set up a play based on where you really think they're going to go value-wise, and you play it. And at no time, ever, are we chasing anything. We buy things when they're on sale. And if they're not on sale, we don't buy them. Simple concept. And out of, where was this? Did we summarize this? Of course we did. 10 winning trades out of 13 with a $24,000 profit on the 10 trades. I'm not on the 10 trades, on all the trades, the net profit of that. And it's the same as we did in the 3 months before that, in the first quarter, or in the first quarter of the fiscal year for the top trade alert. It started in August or something. It's not hard. But the hardest thing is the patience. So it's so hard for me to get people to be patient. And we were just talking about that in chat right before the webinar. Everybody's, can you make a play on this? Can you make a play on that? And I'm saying no. I'm like, yeah, you could do this and you could do that, but I wouldn't do it because it's not a good time. Because it's not a cheap stock. I'll show you if we can get to it. Just because something's in the news or people are talking about it or you heard something doesn't mean it's a good time to buy it. It means it's a good time to watch it. Where were we about that? Somebody asked me about Google. And I said, he said, I said, so how would you play Google? And I'm like, well, I mean, if you want to play it, here's how I play it. It doesn't matter how you play it. I said, oh, yeah, here it is. I said, I talked about versus Microsoft to decide as an example of whether it's good or not. But I said it depends if you want to sell the puts. Do you really want to own Google? It's hard to say I would really want to own a $1,000 stock. How many shares of a $1,000 stock do you want to own? And we're trading in blocks of 100 when we do options. And his premise is it's going up 20%. I'm like, well, that's a nice premise, but you're going to put quite a lot of capital at risk, and you need a 20% gain to win. I don't like trades like that, and I certainly don't like making a trade with 850, which is 20% lower in May. It's gone up 20% since May already. So should Google be going up at a rate of 40% per year? Is that normal? Is that sustainable? Of course it isn't. So if you ask me about the same thing, if Google's back at 850 because something happened, because Europe fines them or something like that, and they have to pay some huge amount of money for tax evasion or something, great. Then I'll look at it and say, well, okay, they got caught for tax evasion. They're not going to evade taxes again. It's going to impact their earnings by a definable amount of money, and we can see going forward that they're still worth this much. That's what I want to buy a stock, not when it's at 1,000 because I'm going to bet it's going to go to 1,200 and jump another 20%. Maybe it will. God bless them. But I've got 24 other stocks I could buy when they're on sale. I'm not saying because I don't want to buy Google doesn't mean I think it's a bad stock. It just means I had no interest in buying it when it's expensive. You know, I'm looking at cars now. My lease is up on my other car, and I was looking at the regular Range Rover, and that's like $90,000 or something like that. And then there's the Autograph. I think it's called Autograph, something like that. Anyway, whatever it's called, $250,000. Same car. The leather was definitely nicer, better leather. I'm not quite sure what else was better about it, frankly, but the leather was unbelievable. Still, though, I'm like, why would I pay 2.5 times for the same car? It's really, nobody can tell, other than the little thing that says Autograph on the back of it. How can you possibly tell this car is 2.5 times more expensive? And I'm not a car show-off guy anyway. I'm actually looking for a used one. I want to get a used one, you know, and like, you know, because I'm going to beat it up. So why not, you know, buy one that's already beaten up a little bit, and save money. Again, I like to buy things on sale. So I'm looking for a used one in good condition. So, but anyway, so the point is, I'm not going to chase the best one. I don't want the newest one. I want one that's on sale. I want one that's a good price. Because why wouldn't I? And it goes back to the thing. So, and if they don't have one now, because I got about a month before I turn in my next car, so I'm under a little bit of pressure to do something. But you know what? Rather than overpay for a car, $10,000, $20,000, I could easily rent a car for a month for $500 and for another month for $500. You know, I can do that if I want to while I'm waiting. I don't need to immediately get a car. I'm certainly not going to waste $20,000 because of some arbitrary timer. I'm going to find a car I think is a good deal, and I'm going to buy it when it's a good deal. And as we talked about last week, if you just make these little decisions in your life over and over and over again, it adds up to an incredible amount of money down the road. But you've got to make those decisions. And I'm not talking about being cheap. I'm just talking about being sensible, saying, why should I be taken advantage of? Why should I buy a brand new car for $100,000 when I drive it off the lot, it's worth $85,000, when I could buy one somebody already drove off the lot and drove for a year, you know, somebody had a year lease or whatever their thing is, and somebody has the car, has 10,000 miles on it, and they're going to sell it to me for $75,000. Why don't I buy that one? Why don't I save $25,000? Why would I not do that? You know, I understand people like new cars and this and that and whatever, but I'm just saying, to me, it's new to me. I don't care. I'm not a car guy. Say that right off the bat. But the point is the same with options, the same with anything. It's like, why am I buying a company at the highest price when it often goes to a lower price? Often. Things don't just go up forever. And frankly, if your stock does keep going up forever, then you'll find another one that hasn't gone up forever yet. There's tons of them. There's no reason to put your money into chasing the ones that haven't. Okay, what other stocks do we look at today? Not too many. Well, really? I guess when we look at, oh, here we go. So, well, no, everything we looked at was chasing today. That's the funny thing about this market. So we looked at GLU, we looked at Citibank, we looked at JP Morgan, we looked at CBSH, and somebody saying like that's a bargain. I'm like, it's not a bargain. It's a little teeny pullback. And so everything we looked at today was high. And that's why you don't see any trades here. There's no trade ideas that we went for today because there's nothing really that we were looking at that seemed cheap. In general, as we were just talking about being in neutral, we're waiting for a market pullback. And if we don't get the market pullback, then we'll have to look around. And earnings, by the way, is the greatest time in the world to look around because everything goes on sale. Not everything, but it's always sale, always. Somebody's going to miss their numbers. Somebody's going to do this or that. And what you have to do is you have to go through the pile of people who miss their numbers, find the one that missed their number for silly reasons, and bet on them to come back. Like my daughter. My daughter gets A plus B. She's honor roll student, whatever. But she's always A plus B minus, A minus. B plus A minus. That's it. So she's B plus A minus almost every single time. She comes back with a paper she got a B on. She freaks out. She freaks out about grades. I could care less. I don't know where she gets it from. She didn't get it from me. So she has a B, and it's a bad report, right? Her stock, in her mind especially, her stock went down. She's like freaking out about what if they see this on the transcript and whatever. I'm like, Jackie, they really don't look that closely at your transcript. But the point is, I'm willing to bet on her. She had one bad grade. I don't mind one bad grade. I know the nature of the person over the long term. I know she'll come back, and she did. She just came back in the same class. I think it was 29 out of 30 best in her class on the next test. Not to brag, she's good. I mean, she works her ass off though. It's amazing discipline. I've never had that kind of academic discipline. Mostly because it came easy to me, and I never felt like the urge to go the extra step and knock myself out to get an A plus when I can get an A minus by not doing anything. But she's the other way. She's as smart as I am as far as that goes, but then she wants that A plus every time. She's driven to be like really good. But the point is that you guys all go through this experience. You know a person, like you know your kids. You know what they're capable of. You know what they can bring home. You know they'll strike out. They'll have a bad day at bat, and you say, hey, you'll get them next time. Don't worry. You've got skills, and you can work on this and work on that. It's the same with a company. Stop thinking about your companies like they're random numbers on a piece of paper. They're not. There's a whole operation there. There's a business there. And the business is either a good business or a bad business. They're in a good environment. They're in a bad environment. They're making good decisions. They're making bad decisions. But it's generally like GE. They've got a phenomenal track record of making good decisions, of making the right adjustments, of pulling things out, and coming up with a better business plan whenever the one they have isn't working, then you stick with them. And especially when they're being given away, just like a cheap baseball player, like the Moneyball thing with Boston. Like if players who are generally good players have a bad season and get dumped by their team, the Red Sox were jumping in, scooping them up. Because what one guy considers a bad player, they consider an incredible bargain. And that's what companies are like. So we have companies on a watch list, and let's see if we have our watch list. A lot of questions? Not really. Okay, hang on. So let's take a look at that first before we get back to questions. So I'm pretty sure here somewhere is a watch list. Portfolio review, top trade review, portfolio review, watch list. Aha. So here's our watch list, 24 stocks, and it's been expanded a bit since. So who's on our watch list? Aflac took off, no good. BMY took off, no good. Delta took off, no good. Boy, what a good watch list there, right? ESRX, cheap. And we added them. See what it says in note there? We added them to long-term portfolio a little early, and we've added more since. So they got cheaper. FCX, still a good price. Freddie Mac, what the hell date was that? 5/9.